And welcome back to your latest housing market update. I have some breaking news to share with you guys because average mortgage rates just increased yet again. Absolutely insane. I can't believe this. We're basically at 23-year highs for average rates right now. So I don't want to waste your time. Let's just go ahead and dive right into the video here. According to Investopedia today, which is August 22nd at the time of filming this video, the average 30-year fix is at 7.76%. And that's for people with great credit, by the way, as well. So when looking at daily rates, according to the Mortgage News Daily, they actually have data that only goes back to the year of 2009. As you can see, current rates right now are well above 2009's levels. So instead, we have to actually look at weekly rates according to Freddie Mac. When looking at weekly rates at 7.49%, this is the highest rates we've had going back to the week of December 4th, 2000, when then the weekly rate was at 7.54%. I want to share some examples about how this is impacting current home buyers right now. I made this video or kind of comparison in my video from yesterday, but a lot of you guys mentioned how home prices have been increasing over the past 2 years. So we really have to look at the median sold price 2 years ago compared to now, right? Versus just a $400,000 home. So thank you so much for everyone who commented on my video regarding we should be looking at the increase in prices when looking at the differences in your average monthly housing payment over the past 2-3 years plus, right? So looking at home prices from 2 years ago, this is July of 2021. Back then, the median sold price was $365,000. And back then, the average mortgage rate was around 2.9%. So looking at someone buying a median price home in the US at $365,000, putting 5% down at 2.9%, excluding insurance, taxes, and HOA, because that varies widely by the neighborhood, the city, and of course the state as well. So only looking at P9, your housing payment would be $1,443 per month. Look at this though. Daily rates today at 7.49%. Your median sold price, according to the National Association of Realtors, they actually just posted that on the 22nd, regarding July's numbers, was just under $407,000. Let's just call it $407,000 even, right? At virtually 7.5%. Your new housing payment would be a whopping $2,701 per month. And by my analysis here, that's an increase of $1,257 more per month to buy a median price home today compared to 2 years ago. That's a giant increase of 87% when taking consideration the rise in home prices. When only looking at a $400,000 home today compared to 2 years ago, that was only an increase of about $1,000 more per month, an increase of about 68%. But when accounting for the fact that prices have increased from $365,000 to around $407,000, that's a giant increase of 87% in 2 years. I mean, can you say not sustainable? It really frustrates me because I'm a current homeowner. I've been owning a house for 10 years now, but I'm really, I'm just kind of going off lib here, but I really feel for you guys. If you guys are renters, you're seeing your rent going up, you're seeing prices on everything going up, and on top of that, you're seeing that home prices and rates are absolutely skyrocketing. So I imagine a lot of you are really disenchanted by the fact that you may not even be able to buy a house anytime soon, right? So I just want to be cognizant of that. There's a lot of people who are watching today's video who are renters, who do want to own a home someday, but we're seeing trends like this, which is very discouraging to say the least. Anyways, there's so much to report on the housing market, but this kind of just irks me because we have a lack of housing affordability. The dream of homeownership amongst a lot of people has been ruined because of these fluctuations here. Anyways, I'll go on. So that's number one, the increase in rates by about nearly $1,300 per month. But number two, because rates have increased by about 4.6 percentage points, going from 2.9 to around 7.5%, that causes your buyer's purchasing power to decrease by nearly 50%. To be exact, buyers' purchasing power decreased by about 46% because rates increased by 4.6 percentage points, right? That's number 3, or actually that's number 2. Number 3 is the giant amount of interest paid over the life of a 30-year fixed rate loan due to the rise in rates. So for example, looking at rates at 2.9%, you're going to pay around $173,000 in interest paid over the life of that 30-year fixed rate loan. However, though, when accounting for a rate of 7.5%, you're going to pay a lot more interest. Go figure, right? Interest paid over the life of the 30-year loan, just under $586,000. The delta on that is a gain of $413,000 more in interest paid because rates have been absolutely skyrocketing as of late. But wait, there's more, right? Because rates at 2.9%, a good chunk of your payment is going to pay down your loan balance. That's your principal loan balance. So your first housing payment of $1,443, about $605 goes to paying down your loan balance, and $838 goes to paying interest. That's your first housing payment. When looking at rates at 7.5% though, you're only paying down $287.53 in your first housing payment versus a whopping $2,413 in interest paid in your first housing payment. So big picture here, to summarize this, the rise in rates from 2.9 to about 7.5%, you're going to be paying around $1,257 more in your housing payment to buy a median price home. I'd say today, but it's technically July this year compared to July of 2021. That's a whopping increase of 87%. I don't know about you guys, but my pay raise did not rise by 87% in 2 years. On top of that, buyers' purchasing power just decreased by about 46% as well, and you're going to pay about $413,000 more in interest paid due to the surge in rates. And because of this fiasco regarding the rise in rates and prices, housing affordability as of June, when rates were much lower than they are today, housing affordability, according to the National Association of Realtors, as of August 15th, actually decreased to an all-time record low based on my own analysis of their data here. It says at a national level, housing affordability decreased in June. Keep in mind, there's a very big lag here because this was just posted on August 15th. Obviously, back in June, rates were much lower than compared to now, which I'll share with you guys here in a little bit. But on a national level, housing affordability decreased in June compared to the previous month and also compared to any single month going back to 1989. But compared to the prior month, the monthly mortgage payment increased by 6.6%. So your average monthly housing payment increased by 6.6% compared to the previous month, which was May, while the median price of a single-family house increased by 3.6%. The monthly mortgage payment increased by $135 more per month compared to just 1 month ago. So that's month-on-month changes. Compared to 1 year ago, affordability fell in June as the monthly mortgage payment climbed 12.1%. So your average monthly housing payment increased by about 12.1% compared to 1 year ago. Yet, family incomes only increased by 4.2%. So we can't have an environment where home prices, or I should say average monthly housing payments, increased by more than 10%, whereas incomes only increased by 4%. I mean, can you say not sustainable? The effective 30-year fixed rate mortgage rate was 6.79% in June compared to 5.60% 1 year ago. So they have what's called their Housing Affordability Index, or their HAI. And that's defined as the following here. This measures whether or not a typical family earns enough income to qualify for a mortgage loan on a typical home at a national and regional level based on the most recent price and income data. So they look at income data and price data based on the nation as a whole and also based on each of the major regions as well. So in looking at this here, at 87.8, this is of course much lower than the peak or the 12-month peak that was set back in January at around 104. And also it's much higher, or actually much lower, I should say, compared to 1 year ago when the index was 94.5. However, though, I actually looked at a historical file from the National Association of Realtors, which, by the way, if you guys want access to this file, it's $1,500 if you are not a member of NAR, which I am. If you are a member of NAR, you can get this for free, and I can share this with you guys for free in today's video here. So here's a look at their index at 87.8. Again, the all-time record low for data that goes all the way back until January of 1989. You got that right. Because rates have increased, and of course because home prices have been on the rise as well, at least as of June, housing affordability reached an all-time record low for as far back as 1989. Absolutely insane. Also, the average monthly housing payment of principal and interest is $2,167 per month, and that too is an all-time record high. On top of that, your median family income, this is on a national level, the median family income, keyword family, not looking at individuals, family income of around $91,000. However, the qualifying income in order to buy a median price home at $416,000 at a 6.79% rate, you would need a qualifying income of around $104,000 per year. But the median family income is only $91,000. Can you say not sustainable, right? On top of that, at $104,016, this is also an all-time record high, and the first time it's been over $100,000. And which, by the way, the previous all-time record high was set back in October of 2022 at $98,000. Here's something that's absolutely wild, since we're kind of talking about changes compared to 2 years ago in June or July 2021. Look at the qualifying income back in June of 2020, just under $50,000. Therefore, the qualifying income today is about double that from just about 2 years ago. Additionally, as I mentioned, average rates are much higher than the rates they're quoting in this report here, because this is back from June. At 6.79%, rates right now are much higher today. So for example, let me look at our good Uncle Fred here. And the source here is Freddie Mac. So looking at monthly rates so far for the month of August, average 30-year fixed rate mortgages for people with great credit is at 6.90%. Again, this report here actually is looking at rates at only 6.9%. Therefore, once they release July and August's data here, this number is likely to be a lot bigger. And of course, this number right here is likely to be a lot lower. I would imagine we're going to get into new all-time record lows for housing affordability once again, once they update these numbers here for rates. And by the way, on a side note right here, if you guys are nerdy like me, you probably realize here that these rates right here are higher than what Fred pulls from Freddie Mac's website here. So for example, at 6.79% as of June, according to Freddie Mac, it was actually at 6.71%, not 6.79%. However, the National Association of Realtors actually includes the amount of points paid by the borrower. Therefore, the average mortgage rate is actually higher in this report compared to what Freddie Mac is reporting on their website. Now, having said that, the data I'm sharing in today's video is likely to look a lot worse once they publish July's data, when rates were at 6.84%, and also August data, of course, when rates are around 7% as well for the month as a whole on average. NAR also published the areas that are the most affordable, and of course the areas that are the least affordable as well. So according to them, the most affordable region in the US was actually in the Midwest. They break down the US in 4 major regions: the Midwest, the West, the South, and of course the Northeast. So the most affordable region was in the Midwest. Their index was 113.7. Get this, the median family income in the Midwest was just under $90,000. However, the qualifying income, go figure, was less than the median family income. So the qualifying income was only just under $79,000. In contrast, the least affordable region was actually located in the West. The median family income was just under $100,000, yet the qualifying income was a whopping $156,000. Not sustainable, right? You can't have a qualifying income of $156,000 when only the median family income was just under $100,000. And here's a chart showing just that. In blue here is your family income. The red here is the qualifying income. This is the income required in order to afford a median price home in the West. In the West, I should say. A big disparity here, the delta on that is $56,000. Compare that to the South, income of just under $84,000. You would need $94,000 to qualify for a home there. The Midwest, just the opposite. Income is higher than the qualifying income. That's the way it really should be. The Northeast, $104,000 versus $121,000 in qualifying income. But for the U.S. as a whole, $91,000, but the qualifying income is over $104,000. Here's a chart looking at monthly mortgage payments as well. Again, all-time record high of just under $2,200 per month in principal and interest. Compare that to in June last year, it was $1,933. The significance regarding this is that back in June last year, we had all-time record highs for home prices, yet your monthly housing payment is actually higher today than it was back then because rates are so much higher compared to 1 year ago. So please leave me a comment below with your biggest takeaways from today's video. Also, please leave me a comment below with your thoughts about what is going to happen with our US housing market for the remainder of the year, because the stats I'm sharing in today's video are definitely not sustainable. We can't have all-time record highs or all-time record lows for housing affordability and for the average monthly housing payment to increase at a much greater rate than the increase in family incomes as well. But please leave me a comment below with your biggest takeaways and of course your real estate market predictions as well. Thank you so much for watching today's video. I appreciate you. Like and subscribe, and I'll see you in the next video.